Oh, there's fresh.
Great. We're about to start.
Real quick, can you mute everyone else?
Yeah, everybody will be muted.
Okay, great.
Hi, everybody. We just started the webinar. We're going to give it a minute or two just while people start joining. So bear with us for a few minutes and then we'll start the presentation. Looks like people are still jumping on.
What's up, guys?
Hey,
Hi, Max. All right, and everybody, this is being recorded as well. So if you miss a section or have to take a call, because you've registered, you'll automatically be sent a recording of this. So we'll go ahead and get started. We're very excited about this opportunity. This is a deal in Sacramento. We've been very active in this market, and we actually own 2 properties on this street as well. So Sacramento, I know many people, they hear California, and that's not the most enthusiastic place for them to invest. But, really Sacramento has benefited from a lot of inbound migration. So what gets a lot of press is people leaving the state of California, and that is happening to a certain extent. But what does not get as much press is the relocation within the state of California. So there's been a huge demographic shift away from the kind of traditional expensive coastal markets towards more affordable markets. And Sacramento is really seeing a lot of inbound migration from those demographic shifts. Next slide, please. So my name is Andrew Lucas. Many of you guys know me, but we do have some new faces on the webinar. I head our capital raising and our investor relations. Shortly, you'll be hearing from Farhan Mahmood. Farhan is a partner at Tryon, and he oversees all of our West Coast acquisitions. So he really is the one closest to this deal. Next slide, please. And then Max and Mitch, if you're not familiar with them, they are 2 managing partners. They actually both live in Miami now, and Farhan oversees the West Coast office and our West Coast acquisitions pipeline. Next slide, please. And so here's just a snapshot of kind of a couple of our, important people at our corporate office. We also have Josh Van Meter on the presentation as well. He is our regional manager based in Sacramento. And we have a unique kind of insight into this asset that we're buying because he was actually an employee of the previous owner when they were renovating the property. So any deal that we buy, we obviously do a tremendous amount of due diligence and try to make sure we're very comfortable with the physical condition of the property. But in this specific instance, we have even more of a knowledge base because Josh was an employee of the previous owner who actually went through and did the renovations at the asset. So at the corporate level today, we have in total, we have about 110 employees, about 35 at the corporate level. And one of the things that I think makes Tryon unique is, I think last time I checked, about 24 of our employees had either their money or their family's money invested in Tryon's deals or our funds. So I think, one of the things people ask me is what makes you unique. One of them is that our employee base has a tremendous amount of skin in the game, and that really creates a culture of alignment where we're really rowing the boat in the same direction as our investors. Next slide, please. So we've been around since 2005. We've done about 8,600 units in total. And in total capitalization, that's about 1.8 million. So I think another thing that, somewhat sets us apart is we've been around nearly 20 years. And we've demonstrated the ability to perform well, as a company and for our investors in good economic times and in bad economic times. We didn't survive the Great Recession. We thrived during the Great Recession. And, it's no secret right now that we're heading into some choppy waters with the economy. And we feel like we're very well positioned to invest defensively and have a very successful next 3 to 5 years. Next slide, please. So we included, this is our current portfolio. I know it doesn't present well on a webinar, but we wanted to include it just because people oftentimes request the deck. Next slide, please. This is every property that we've sold. So we've had 40 exits since our founding in 2005. And on those exits, we have achieved internal rates of return north of 30%. We're not targeting or promising that in the current environment, but we do have a robust track record, and historically we have been able to under promise and over deliver. Next slide, please. So with that, I'm going to turn it over to Farhan, and then we'll hear from Josh as well. This is just a couple of the investment highlights. And then Farhan, take it away.
Awesome. Thank you. Great job, Andrew.
Thank you.
So, a question that I assume that we may get is, why invest now? Andrew mentioned when we're facing a recession, and part of that reason, a big part of that reason, maybe the main reason, is prices are adjusting. And so this deal, beginning middle of last year, it would have traded at a 3.5 cap, going to an untrended 5% cap. Today, we're buying it at a mid-4, going to 6% cap. And I know it would have traded at 3.5% to a 5% cap, not only because we know the market, but also because the first came in off market was at least $4 million higher than the current purchase price we had it at. The seller decided that they were going to take it out to the market, try to get $30 million for this asset. And at that time, that was a reasonable thought. It went out to market, got a bunch of offers. There was a best and final. We weren't actually one of the groups that were invited to best and final, because we weren't in that pricing range for the best and final. Now the market shifted. People got nervous and backed out of the deal, and the deal came back to us on a broken sale process, and we were able to go in and get the deal at 24 million when they were originally targeting that $30 million price. Now, our bet that we're trying to make is that on a base case in the next 3 years, we'll be able to get back to that $30 million price in the next 3 years, or in a bear case within the next 5 years. A lot of people, in the real estate industry today, Barry Stern, last week on the Starwood earnings call, said the base case is that interest rates are going to come back down. And so when interest rates come back down, we think there'll be an opportunity to sell. We're not underwriting it that way. We're underwriting it to exit at a 5% cap, and there's 35% upside on the NOI there that will justify that price that this deal would have been able to sell at, maybe even 6 months ago. And so what's nice is we're able to make that bet on a fixed rate basis. So the senior loan is an $12 million loan, 4.19%. The second loan is 28% of the stack is a 12% coupon, a 3.7% hard pay. All in all, it's 68% loan to cost. And we are able to get to a trended 9.5% debt yield. And so what that means, the 9.5% debt yield, is if at the end of 3 years that we're not in a position to sell, or the market's not in a position to sell, we should be in a position to refinance even with increasing rates. Now, we're going to pitch you this deal. We're going to tell you guys a lot about why we like this deal, but we're also not just saying it in our words, we're also saying it, or we're showing it in our actions. Tryon, a immediate family member, is investing 40% of the equity check, and I think that tells you a little bit about how much we like this deal. One of the reasons we like this deal is that the pro forma rent has been achieved on the last 22 leases. And so our goal is to move the rest of the rent roll to the last 22 leases. So there's 104 units, so 82 units going to the last 22 leases. That's, we usually don't see a deal where we've had 100% renovation that we could just push on loss to lease and get kind of those value added returns. Now, the other item Andrew mentioned is that we own 2 properties on the street. This is a very common strategy for Tryon, is when we like a location, we see the demand of particular assets in a location, we try to buy more assets close by. And so it's almost like a real estate version of legal insider trading, when you can get the intel from the properties down the street and use it to buy more properties in the same location. So those 2 properties are within half a mile of this property, and we're going to benefit from being able to, the infrastructure to be able to manage those properties together. The next item, one of the reasons we like the location. So that South Arden location, there's $1 million homes nearby. There's really excellent retail nearby. Generally, I would say the apartments are maybe what has historically been holding that area down a little bit, but what we've seen as groups ourselves and groups like us are coming in, fixing up the apartments, and we believe over time that location is going to continue to get better. Now, on a macro basis, what we really like about the location, Sacramento location, is very little supply. On average, about 2,000 units or 2,000 units are being delivered per year. At its peak, Sacramento had north of 30,000 people moving in to the market. And the two bases of the economy are government and healthcare. Those two bases did well, in our last big recession during COVID. And we think those are strong bases going into a potential recession. Now, the last item I'm going to talk about is the renovations are excellent. And I'm going to talk a little bit about the renovations, but I'm going to let Josh talk about it a little bit more. But, they re-stuccoed the building, new windows, new roofs, new concrete, new decks, washer dryers in every single unit. They opened up the kitchens, as you see in some. One question that we're asked fairly often. One question we're asked fairly often is what are the buying a deal? And one of the big risks is that once you start the walls, you find things that maybe you weren't expecting, and that's not the case here because renovation's been complete, and so it's very rare that you can get value add returns on a property that's already been renovated. And so our goal is to move the NOI 35%, take it back out. We hope to get yesterday's pricing in 3 to 5 years, and sell it to an exchange buyer. The deal is a good size for an exchange buyer. The exit pricing we're projecting is in the $30 million range. There's a lot of 1031 buyers in that range, and they want these 100-unit properties that in these strong locations. And so the goal is in 3 years to do that exit. So with that, I'm going to introduce to you guys a special guest today, Josh Van Meter. Josh has, he's just got a wealth of knowledge. He's been in the Sacramento area for a long time. Andrew mentioned he actually oversaw a lot of the renovation at this property, which is just unique that we get that kind of insight. And we do talk about how we are vertically integrated. We self-manage. We have project management teams. We have marketing teams. We have our crews, and we have boots on the ground. And so we thought today might be a really good opportunity to introduce to you someone on the management side, as you guys are used to talking to Andrew and Max and people on the principal side. But I think it's going to be it's a good idea to introduce you someone on the management side. So with that, Josh, how are you doing today?
I'm doing great, actually. Yeah, great day.
Thank you for joining us. Why don't you tell everyone just a little bit about yourself and about your experience and what you do for Triad?
Absolutely. So I've actually been working in the multifamily industry for about 17 years, primarily in the Sacramento market. I've worked for several different companies. Some were fee-based, some were owner-operated. And then for actually 12 of those years, I did work for a company called JCM Partners. They're actually who did the renovations at Courtyard. They were the company, we purchased it, we completely renovated it, and then we sold it to another company in about 2015, 2016, somewhere in that ballpark. And with that property, I did do a lot of the project management. So dealing with, contractors for the exterior, for interiors, walking units during the renovation process, dealing with vendors for the flat work, for the landscaping, that kind of stuff. So I am, very knowledgeable about that property. Currently with Tryon, I am a regional manager. I oversee the Northern California portfolio. So I do have properties in Sacramento and in the Bay Area. And like Farhan said, 2 of those properties are on Fulton Avenue right now.
Yep. Yep. Now, you joined Tryon somewhat recently. What drove you to, what drew you to Tryon, and kind of what interested you in Tryon? And sorry, I'm moving this presentation a little bit so we can get some pictures of the asset up.
Yeah, no problem. Great question. Originally, I really liked the business model that Tryon has. You buy a property, whether it's a distressed property or, like this asset that's already a little renovated, and you do some work either to NOI or to the renovations, and then you sell it for a profit. I love that business model. That's very similar to what I did for 12 years with JCM. It's what I'm used to. It's what I love. And it is a great business model. And then, as time went on working for Tryon, I really got to see how intelligent and just very knowledgeable in multifamily the executives are. Everyone at the corporate office, they really know what they're doing. And that's not an easy find.
Awesome. Yeah, it's interesting. We definitely aren't buying renovated assets, but when you can get a renovated asset at non-renovated pricing, that's telling. And really, you don't see that in an up market. You see that in the down market that we're kind of starting to see. And so with that, will you go into maybe a little bit more on some of the renovations at the property and your experience operating the property, what you liked and kind of what you saw there at your first round on the property?
Yeah. So, when I worked for JCM, we bought the property. It was all wood siding. It was very old looking. It had a lot of deferred maintenance. So we kind of went in and, we touched everything. So we did asphalt, full landscaping, including irrigation, stuccoed the exterior, built brand new patios, installed dual pane windows, full interior upgrade, from texturing every wall inside the unit, to installing all new cabinets, counters, so everything new. We even went into detail to put new trash enclosures in, to just kind of put that finishing touch on, so that everything looks like it's new and perfect. And the big thing with JCM when I worked for them is they didn't cut corners. So what we would do is we would usually use the same vendor to build that relationship and build that rapport, to make sure they were aware that we didn't cut corners and we did things the right way. As an example, not at this asset, but at another asset we had, we took the siding off because we were going to install stucco, and we realized when the property was built in the 70s, it had no insulation. So it was just bare walls. So instead of just stuccoing over that, we went and added insulation, even though it wasn't in the budget, because we wanted to make sure it was done the right way. And that's the benefit of a JCM upgrade, is it was done correct, and it's going to last for a long time. And I think that shows a lot, especially on this asset. It's 6-7 years into the renovation and it still looks gorgeous, and it's going to for the next 30 years.
Agree. I think the pictures don't quite do it justice either. I mean, when you're walking the asset, it feels really, really. It's interesting that JCM chose to stucco the exterior. That is, typically on the wood sidings, you're replacing with, party, or you're not doing the stucco. Stucco is typically more expensive. Do you know why? Was this something kind of regular on the JCM renovations where they restucco the exteriors?
Yeah, it was super common. We did it at a lot of our assets, and we did it because we know stucco lasts longer. And if somebody's looking to buy, they can see that and go, you know what, that stucco is going to last forever. That's the expense that I'm not going to have to deal with. I'm not going to have to go do dry rot. Even Hardy, Hardy lasts for a long time, but nowhere compared to as long as stucco.
Yeah. Now Tryon owns, like we've said a few times, 2 other properties on the street within a very short distance. What do you think? What's your kind of thoughts on the location? How do you think about it?
The location is great. So first off, Fulton is a really busy street. And the benefit that from a management standpoint is you get a ton of drive-by traffic. That's free advertising that we're not paying for. You have the monument sign out front. You have this beautiful property out front. People are going to drive by and be drawn to go in there. So you're going to get a lot of walk-in traffic to makes it much easier to rent the units quickly. That's a big benefit there. The other thing is it's very close to Sac State, which is not something people would typically think of. Getting student housing is awesome during the summers when students look to move, and we can capture a lot of those students, at the property, and they're always willing to pay more. They're used to paying even higher. I worked at a property right by Sac State, and I mean, the rents were crazy there because the students will pay for it. So being so close, I think is going to be a huge benefit. And we've already seen that at our other 2 properties as well.
Yeah, makes sense. And, maybe to finish it up, what are your kind of just general thoughts on the Sacramento market? And you've been there so long, what's your view? What's drawn you to Sacramento as a whole? And what's your view on it?
The Sacramento market, growth has been just off the charts for the last few years. We all know that. We've seen the numbers that rents have just skyrocketed. They've kind of we're starting to see it kind of normalize. So you're still seeing increases, but nothing, like the last 3 years, which is still great. However, I can tell you that in October and November of this year, traffic has been just really amazing. And typically it's slow this time of year for us. October, November, December is usually the slow time. We don't see a lot of people coming in looking for apartment, but it has just been exploded in the last couple months, which is great. I think from what I've seen in the, over the last 17 years, I foresee traffic staying consistent and busy throughout Sacramento. And you can see that right now, occupancy throughout Sacramento is 97%. So there's just not enough buildings. They're not building enough new properties. And the properties that they are building new are ridiculously expensive. So we're still going to capture those people that are looking for a nice property, but don't want to spend, $3,000 a month for that, like they would at a brand new construction.
Yeah, it's interesting. A property exactly this size in the Bay Area market would trade for $450 a door, and so it's almost literally half price. I like that you said the next 17 years. I hope the next 15 years hopefully would try on. That's a good way to look at it. Anything else that you want to add before we kind of start taking Q&A?
Yeah, absolutely. One thing is, and I realize this, I've been, with Tryon for a little while now, is what Tryon has to add to this. Currently, Courtyard is being managed by a third-party management, and they are great. It's a company that I worked for in the past. They are a great company, but at the end of the day, they're just a management company. They're not invested in the property, whereas Tryon is invested in the property. So for us, we're going to do whatever we can to increase the value, increase NOI. So we will look at cutting expenses, shortening turn times to make sure vacancy loss is low. Just there's so many things that we can do to add value to the property. And I think that's going to come around like immediately. I think within the first 6 months, we're going to see NOI shift in an upward direction.
Awesome. Okay, cool. Thanks so much for joining us, Josh. Andrew, I'm thinking I'm going to push it. Well, before I push it back to you, I think, I just want to put my last 2 cents on it, is that this is fully renovated building, low risk reward, value add returns. And our goal is to exit in 3 to 5 years at pricing that would have been achievable at the beginning of this year, while we're pushing NOI 35%. And so it feels like a relatively simple deal. We know the market really well. It feels straightforward. We have the fixed rate debt. And so we're not doing a ton of deals right now. While we're getting a lot of headwinds. And so because this was so straightforward, this is a deal that we thought was worth taking on even as we move into this portion of the economy. And so with that, I'll give it to Andrew to kick off the Q&A.
Yeah, thanks, Farhan. Thanks, Josh. So if you have any questions, please enter them in the Q&A box. I'll read them off and then we can collectively answer them. So one question that we have is, given the current environment, Farhan, why is the current owner selling?
Yeah, it's so owners, a mom and pop, they have a third-party asset manager and the third-party property manager, and it's one of the last assets that they own in the market, and so it was their plan to sell and move on.
Got it. Okay, thank you. In the offering summary, you said that strong basis. Prices is falling post-rate shock by approximately 25%. Is this for this property specifically or Trion's portfolio as a whole? What does this pricing say about assets that you purchased in the past few years? And how do you think about the value of the existing assets today? So I'll speak to that and then I'll let you give a little more in-depth explanation. So, I mean, we are not selling any, we're selling one deal right now, but we're not really selling any of the properties that we acquired in 2021 or 2022 at this point. We have been very disciplined in our underwriting. So we never bought into, 3.75 exit caps. So, we were pretty disciplined in how we made our acquisitions over the last couple of years. So again, we're not selling anything today outside of one deal that we're selling from Fund 2. We think our current portfolio will perform as expected. And then Farhan, if you have anything to add.
Yeah, and what I'll add to that, it's hard to know exactly. It's hard to know exactly how to think about values. There's not a lot that is trading right now, the view, I think the real estate industry view is that values will rebound within the next 3 years. And so a lot of sellers prudently aren't selling right now. And so we will wait for the right time in the market to sell these assets that we bought recently.
Okay, the next question. Do you expect there to be pass-through depreciation to the investors in 2022? I guess to piggyback on that question is, Farhan, when is the anticipated close date?
Yeah, so it's a loan assumption. So it's not completely in our control, but we're targeting an end of year close that might trickle into 2023.
So yeah, to answer that, because it's a loan assumption, it has to go through and get approved. So we're targeting the close at the end of this year, but it's possible it could spill into 2023. What is the age of the facility and what is the turnover and sale history?
Yes, 1970 built, but they've had a lot of renovation, including into the systems. Turnover and sales history. So it was sold 5 years ago. It was last sold 5 years ago. Before that, it was sold in 2005. It was sold for roughly 18 million 5 years ago. There's been tremendous growth in the Sacramento market, and which is why, we're seeing the $24 million sale today.
Thank you. Discuss your purchase price of the other two Folsom properties, price per key, was it value add, and the rent trends in Q3 2022.
Yeah, sure. So Fulton properties, the street is Fulton. The last property we bought was $230 a door. It was 0% renovated. It was an inferior property to this. It didn't have the amenities or the grounds that this had. It was a 4% going in cap rate. And then the other Fulton property, that was a little bit tougher to peg. It was part of a 5-property portfolio. The strategy on that one, we got a really good deal on that one. The strategy on that one was buy wholesale and then sell off the parts, basically. And so we got a discount for buying 5 properties at once. It was everything from a 4-plex to 84 unit property, and we bought that for roughly 170 a door, 165 a door, I think it was. But yeah, we got a good deal on that one. And then I think the other deals on the street. So on a per door basis, we're at 230 a door. We're also 270 a foot. There's unrenovated deals that are in the low to mid 200s per door, but they traded in a mid 3 cap and north of 350, 390 a square foot. And so some of that discount we're getting on a square foot basis, and then the discount because it's renovated. We've seen other deals in the market. That have traded between 300 and 350 a door that are further along in the renovation. So we're at 230 a door. Our goal is to exit in the low 300s a door within the next 3 to 5 years.
Got it. Is it fully renovated? If so, what's the current positive cash flow? So yes, the property is fully renovated. And again, as Farhan mentioned earlier, many of the deals we've bought over the years, we actually have to do the work to add the value. On this property, it's really just a management play because the previous owner has fully renovated the property, but they just haven't brought the rents up to market. So it's really just to bring the rents up to market at the property, but the property itself is turnkey. Our projected cash on cash is year 1, 3%, year 2, 5.5%, and then year 3, 4.83%. And this presentation, we condensed our deal brief, but we have the full deal brief available in our investor portal along with the private placement memorandum. I had posted a link in the chat function. So if you click that link and enter your name and email, you'll get an email giving you access to that data room, which contains the full PPM deal brief and all the other information as well. Is your goal on this property approximately 25? So I'll skip that question. Don't quite understand it. What are the reasons you think it's best to exit in less than 5 years? We have the flexibility. So we're underwriting a 3-year hold. We will do what's most accretive to the deal. This is kind of an extreme example, but if Apple decides they're building a headquarters across the street from the property in 2 years, that would influence our decision and we'd likely hold the property longer. Conversely, if the economy rebounds in 2.5 years from today, somebody makes us an offer we can't refuse, and the property may be a headache to manage, then we would sell. So we take into account many factors as to whether or not, we take it, we flip it and take the profit, or if we believe it's more accretive to the deal to hold it longer term, we will do that as well.
Yeah, and our goal basically is we're trying to double the equity, roughly double the equity. And so the goal is double the equity, return money to investors, and then move on to the next project. We hope to get there in 3 years, but we're looking at it on a 3 to 5 year hold.
When will distributions begin? I'll let you answer that, Far.
They'll begin in the first quarter of ownership.
And again, we're projecting 3% year 1, 5.5 year 2, 4.83 year 3. Yes, I should have mentioned this earlier. Will Fund 3 participate in this? Yes, Fund 3 is participating in this. So for those of you on the webinar that are new investors, we offer a fund which spreads your risk over a pool of assets. This, I believe, will be Fund 3's 17th acquisition. And then we actually, from a timing perspective, Fund 3 is closing to new commitments tomorrow. So if you may be interested in more of the diversified portfolio, investing in the fund would give you exposure to this asset, as well as 17 to 18 other multifamily properties in the Western and Southeastern states. Are SDIRA investments accepted, and what's the minimum investment? Great question. Yes, we can accept self-directed IRA investments, or solo 401k plans, defined benefit plans. The minimum investment is $50,000. That's for our fund and direct deals. What percent of units do you expect to be occupied by students? Will they add an element of seasonality to the occupancy rates? Farhan?
Yeah, not a huge percentage. You know, it's close to the school. It's not right next to the school, but not a huge percentage. And you know, definitely less than 20%.
Please scroll to the financial slides in the deck. Do we have a slide far on that shows maybe the return metrics, the target return metrics?
Yeah.
Got it. So as you see here, we're targeting a 3-year hold, an investor level IRR of 16.74, and an investor level equity multiple of 1.56x. So what that means, basically, the simplest kind of way to quantify that is if we hit our metrics and we hold the property for 3 years, if you invest $100,000 upon the sale, once you total up all of the distributions you've received, if we hit our projections, you will receive $156,000. So your initial $100,000 back plus $56,000 of profit over a 3-year hold. Got the questions coming in. I like this. Other managers have shared that prices are down about 10 to 15%. What do you think is the disconnect? I mean, I think we were really talking about this asset specifically just because there was whisper prices around $30 million, and we're able to get it, you know, $24 million. I think I kind of would agree, and it's all market by market, asset by asset, but generally I would agree that, you know, prices are typically down 10 to 15%. I think this asset specifically, we're able to just get it at a very steep discount.
Yeah, it's interesting. This is the only deal in the Sacramento market that is currently under contract over $20 million. There's Max and I were talking yesterday. There were 20 deals in the Seattle market, a market that we like, and 17 have been pulled. And so I think the disconnect is a lot is not selling, and that there is maybe a little bit of a bid-ask spread between buyers and sellers, and not all sellers are motivated in taking the discount.
Are there crime issues in the area? What type of security measures are there in the complex, such as cameras and monitoring?
Yeah, we have cameras. The property is gated. There's not major crime issues in the area. We haven't had any issues on the 2 properties on the street.
Can you go over the debt structure again? What is the blended rate and maturity?
Yeah, so it's a $12 million senior. Let's see, I think I have a slide that shows this. $12 million senior at 4.19%. That's an agency loan that we're assuming. And then 5.5%, that's a 12% coupon with 3.7% hard pay. The blended coupon is 6.6%, and it's 68% loan to cost.
Are you immediately giving rent increases per AB 1482? Please explain how the rent increase process will work during the value add process. Yeah,
there's maximum 10% rent increases in the Sacramento market. We'll give those units that are coming up for lease expiration. We'll give increases when those units come up.
So that's just to kind of reiterate that. So if somebody stays in the unit, they'll get a 10% increase. If they choose to leave, we can then take that unit to market. So California doesn't, Sacramento's under California state rent control. It's not like Santa Monica or West Hollywood where it has its own municipal rent control, and there's no vacancy control. So when a unit does become vacant, we have the ability to take that up to market. And if the tenant remains in the unit, we can issue 10% rental increases.
Yeah.
Are there annual quarterly distributions? How are distributions calculated? So there we distribute quarterly, and then cash flow from operations is distributed quarterly. If it gets to a point where we refinance the property, there would also be a distribution on the refi, most likely. And then the distributions are calculated based on how much cash flow there is to distribute. In terms of the waterfall, it's a 75-25 split with a manager catch-up. So essentially after an 8% preferred return. So basically the profits are split 75% to the investors and 25% to Tryon. We already discussed that. Yes, Fund 3 will probably be investing about $2-3 million, $2-ish million, maybe $2 to $3-ish million into this deal. And one kind of point on that as well. This is a very small raise. So it's $7.9 million that we're raising. Our fund's putting in 2 to 3. A family member of Tryon is putting in about $3.2 million. So there's only about $3-ish million that we're raising. So the last couple deals we've raised like, $15-20 million. So there's the hat was going around for a while. On this deal, we anticipate it to fill up pretty quickly just because we're not raising a huge dollar amount. If you were obtaining new financing currently, what is the rate the loan would be?
Yeah, so on a fixed rate basis, it would be roughly 6%. Now what's tough is the leverage is very low on those loans. The LTV is very, very low because of the DSCR that they're trying to get to. A floating bridge loan is anywhere from 6 to 7% and floating, and you have to buy an interest rate cap, which can cost you close to an additional 4%. The debt markets are very have increased significantly.
Do we have to invest in your fund for this property? No, you can invest in this deal directly. Or you can invest in the fund, which will also be investing in this deal. So if you want to go specific to this asset, you can invest directly in this deal. If you want to go into the fund, you can go into the fund and get exposure to this deal as part of a broader portfolio. Can you please speak on the exit cap of 5%? It seems deals today are already starting to trend to a 5% exit cap.
Yeah, so we cover 12 markets at Tryon right now. We've seen very few deals going in at a 5 cap. We're still seeing deals anywhere from a high 3 cap to kind of a mid 4 cap, and they're trending to kind of a maximum of 5.5 cap. What's nice here, we're getting to a 5.9 return on cost. Of the markets I cover, which is 6 of the 12 markets that Tryon covers, I've only seen 2 other deals that get to a 6% return on cost. And those deals are really rough deals. One of those deals has 20% delinquency, for example. And so in a better return on cost than we've seen across our other markets.
How long is the fixed rate loan for? So the fixed rate loan, you can see here, it matures May 9th, 2029. And it's interest only for when's the interest only expire? Is 60 months after, so mid 2024, the interest only goes out. So then we will have to start paying principal.
That's right.
What is the minimum and maximum investor check size for this deal? The minimum is $50,000. The maximum is about $3 million. And on deals like this, we do anticipate it to go relatively quickly just because it's a small raise. So if you are interested, please execute the subscription documents, and that will kind of like solidify your spot in the queue. And that is our last question. Does anybody, if you have any other questions, feel free to type them. If something pops up afterwards, feel free to send me an email or Farhan an email, and then we'll get back to you. Our deadlines for this property for subscription, or the deadline would be to subscribe. So if you want to invest, execute the subscription documents. Again, we don't have an exact closing date yet. It'll likely be year end, but it is dependent on the approval of the loan assumption. And then we will circulate wiring instructions, as we have that defined date and we have the bank account open. So I just spoke to that last question as well. So we typically call capital 10 days before closing. So, if we have a year-end close, we would likely call it, with the holidays, we'd probably call it the third week of December. So, we're not going to have capital be due in on Christmas or anything like that. All right. Thank you guys all for joining. Again, this is recorded. You will automatically get a recording emailed out to you. So check your inbox. If you have any other questions, feel free to reach out to myself or Farhan. And then I posted the link for the PPM in the chat. If you want information on the fund, send me an email. Happy to share that as well. Thank you so much. Thanks, Farhan. Thanks, Josh.
Thanks, guys.
Have a great afternoon, everyone.
Thank you. Bye-bye.